Good afternoon. Thank you, Kim, for that wonderful introduction, and thank you, George, for asking me to come join this wonderful group. Ben Graham started teaching advanced security analysis at Columbia, actually the extension school, in 1928. So we're now approaching a century of him doing that. And I've had the personal honor of teaching security analysis for each of the last 33 years at Columbia Business School. I'm very mindful of the tradition, and in particular, often imagine Ben Graham sitting in the front row of my classroom. And I wonder if he would approve of what we're talking about in our class. I will say, of course, all intelligent investing is value investing in the sense that it should always pay a price less than value. The challenge I think we face today is that accounting has distorted some simple relationships. And today I will talk about how to accommodate today's world into value investing. So a little bit of modern value investing, if you will. Now, not surprisingly, this did not elude Ben Graham. Let's start by looking at something he said many years ago. And I'm just, if you'll indulge me, I'll actually just read this. This is from the second edition of Security Analysis, and I believe this is the only edition where this actually showed up. So you have to dig a little bit here. You can see it's on page 577, so you have to get into this a bit. This is Ben Graham writing. It may be pointed out that under modern conditions, so-called intangibles are every whit as real from a dollars and cents standpoint as buildings and machinery. Earnings based on these intangibles may be even less vulnerable to competition than those which require only a cash investment in productive facilities. He went on to say, furthermore, when conditions are favorable, the enterprise with a relatively small capital investment is likely to show a more rapid rate of growth. Ordinarily, it can expand its sales and profits at slight expense, and therefore more rapidly and profitably for its stockholder than a business requiring a large plant investment per dollar of sales. By the way, interestingly, you could see that Graham was influenced by, well, he cites it, but he was influenced by a book that was written in 1938 by a guy named Lawrence Bloomberg, no relation to Michael Bloomberg. And that book was called The Investment Value of Goodwill, 1938. So I'd never heard of this book till I saw this. So I tried to find it, couldn't find it, went to my colleague at Columbia Business School, Kent Daniel, and I said, Kent, have you heard of this book? He said, no, but I'll track it down for you. So we tracked down a version from the Columbia University Library, and what they do is they give you a photocopy of it, so they just give you a PDF of the photocopy. But it was really cool. It gave the card of the first people that checked out the book from the library. And in 1939, the first person from Columbia University to check out that book was David Dodd of Graham and Dodd. Isn't that a cool story? So I have a picture of the David Dodd actual thing. So what I want to talk about today, and very much in the spirit of Graham, is the rise of intangibles. Second, talk about the characteristics of intangibles. So when you think about modeling the performance of businesses, the pros and cons that are associated with intangibles. And then finally, of course, why we should care as investors. Now, in very simple terms, businesses are very simple, right? They make investments and they reap the benefit and some sort of return on investment in the form of profits. That basic relationship holds for all businesses, and basically everything else is a detail in some way, shape, or form. Now, those investments can take multiple forms. Investments can be tangible or intangible. Tangible assets, exactly what it sounds like. Physical assets, machines, trucks, inventory sitting on the shelf, factories with smoke spewing out through the smokestack. Intangible assets, by definition, are not physical. They can be customer relationships. They can be product design, instructions for how to manufacture a drug. So there's an exhibit that shows some of the categories of intangible assets based on economists who study this topic. Broad categories would be things like computerized information, right? So software development, something that would be sensible there. Innovative property, so that would be research and development, for instance. Or economic competencies, which captures things like branding, right? So just to make this demarcation between tangible and intangible. Now here's the main story and why the world has changed so much. This is tangible and intangible investments as a percentage of GDP. Go back to 1977, tangible investments were 1.4 times intangible investments. Fast forward to today, intangible investments are 1.7 times tangible investments. By the way, interestingly, Fama French, their very famous paper, Cross-Section of Expected Returns, came out in Journal of Finance of 1992. And if you scan along the x-axis to 1992, you can see that's almost exactly the date at which those lines flipped. So today we're dealing much more with intangible investments than tangible investments, yet many of the tools that we use, including valuation tools like price to earnings, EV to EBITDA, price to book for sure, are all tools that were developed largely in the world prior to this change. Now, one way to look at this specifically is to take a look at the Russell 3000. We show, again, this is the same basic thing. We're showing how much intangibles have grown relative specifically now just to capital expenditures, one component of this. And again, you can see sort of this breakaway, especially in this century that we live in today. So what is the basic issue? The basic issue is when businesses make investments, historically they showed up on the balance sheet. The profits typically showed up on the income statement. The challenge today is that tangible investments are still capitalized and depreciated, as they always have been, but many intangible investments are now expensed. So they show up on the income statement, and that has absolutely wreaked havoc on reported financial statements. Now, one of the fundamental principles in accounting, which you all know, is the principle of matching, which is to say that your expenses should match the revenues in the same period. Anup Srivastava is a professor of accounting at the University of Calgary, did an analysis studying how cost of goods sold, COGS, and SG&A, which included R&D, adhered to the matching principle. So he sorted companies, U.S. public companies, into cohorts based on the decade in which they were listed. So the year they did their initial public offering, from the 1960s to the 2010s. And what he found was the cost of goods sold match revenues effectively and consistently for all the cohorts. So we're good with COGS, we're good with gross profits. SG&A, by the way, also matched revenues well for the early cohorts, the 1960s and 1970s, but you can see that that number degraded very, very rapidly to the point where, and I'll quote Srivastava directly, he says, today, SG&A is practically unmatched to revenues for companies that went public from the 1990s on. And by the way, that's about 80% of the sample that we have today. Therefore, what you should take away from this is that both earnings and book value are going to be distorted relative to the past. Because if your job as an investor is to figure out how much company is a company investing and what is the return on investment going to be, and I do think that's what you should be doing, if you don't have those categories straight for accounting reasons, you're going to be disadvantaged. So how do we deal with this? Well, the classic way to deal with it would be to capitalize intangible investments the same way that we capitalize tangible investments, and then we amortize them over their useful lives. Let me try to bring this to life or make this a little bit more concrete with an example. So I'm going to use Microsoft as our case study here. What we're going to do is to start with a classic definition of free cash flow. So if you took a finance course at any point, this is likely the definition that you learned about. You could see here their EBITA is $117 billion. This is for fiscal 2024. Cash tax is about $20 billion. So their net operating profit after tax was $97 billion, right? So this is straight out of your finance textbooks, nothing fancy here. Now, how much did they invest? Working capital was actually a slight source of cash. CapEx minus depreciation was $38 billion net. Acquisition, $69 billion. That was largely Activision. And so you net these things, you get negative $5 billion of free cash flow. So it was negative for this year for mostly because of Activision. Historically, that number's been substantially positive, right? So this I just want to have in your mind. This is a baseline. This is what you would see with reported financial statements. And again, also bear in mind that negative $5 billion free cash flow number. Okay, so if you decide we're going to capitalize intangibles, there are two very big decisions you have to make. And by the way, I'll just mention that this is a very, very active area of academic research. And I don't know if anybody's converged to a consensus on this. So there's a lot of interesting areas, which I tell my students is very exciting, because if you can really be at the front of this, you can try to understand what's going on. The first big question you have to ask is, what percent of SG&A should be allocated to intangible investments? Now, one way to think about this is, in the SG&A account, what is maintenance, what is necessary to sustain current revenues, and what is discretionary investment in pursuit of incremental profitability. The second question you have to answer is, what is an appropriate amortization period, right? So you amortize intangible assets just as you depreciate physical assets, tangible assets. So it's the same idea. What is the asset lives of these intangibles? So in this particular case, what I'm deferring to is work done by Chuck Holton, who's a professor emeritus at University of Maryland, did a lot of research on intangibles, very active in this field, and he wrote a paper specifically on Microsoft. So we can debate the details of it, but I'm going to use Holton as an illustration of this point because he's done serious and thoughtful work on this. So he said, what percent of SG&A? He said 100% of R&D. I think that, by the way, today would not be the right number. It would be lower than that. For sales and marketing, he argued 70%. And for general administrative, he argued 20%. So these are the numbers for 2024. You can see their total SG&A was about $58 billion. And according to the Holton formula, you would capitalize $48 billion of that. So it's a little over 80% of that total would be capitalized. The second big question is, what is an appropriate amortization period? He argued for R&D it should be 6 years, and for sales and marketing and G&A, 2 years, right? So he's laid out a little framework for us to do these calculations. So now let's apply the Holton calculations to see what happens to Microsoft's financial picture. So on the left are the numbers I just showed you a moment ago, $97 billion of NOPAT, $102 billion investment, negative $5 billion free cash flow, and on the right are including the Holton adjustments. I want to draw your attention just to 2 or 3 numbers. First is NOPAT increases from $97 billion to $108 billion. Now, there's a little bit of rounding in there, but it goes up by about $10 billion. Investment obviously increases by the same amount because we're just reclassifying something. So that goes from $102 billion to $112 billion. Okay, so let's just pause for a moment and just say, if you accept this approach, what this is saying is Microsoft's earnings are understated by about 10% relative to history, or to other companies. Now note the free cash flow stays at negative $5 billion, right? We're not perturbing the free cash flow in any way, shape, or form, and that's also very important. So you might say to yourself, well, if free cash flow is what I'm using in my discounted cash flow model and the number doesn't change, why are you bothering with all this work? And the answer is, again, understanding the magnitude and return on investment. This is a step toward the truth in understanding how much the company is choosing to invest. Now, we can continue this analysis to talk about what it means for return on invested capital. And this is actually quite interesting, and I'm going to show you some macro data in just a second. So on the left is the classic ROIC calculation. We make one assumption here, which I think is reasonable, but you could debate to some degree. We assume that the company required 2% of its revenues in the form of cash. So we adjust that, and that's a reduction in the cash balance and a reduction in shareholders' equity. But you can see basically they had $311 billion of invested capital as of the end of 2024. And if you do the return on average invested capital, you can see that number for ROIC for Microsoft, 38%, right? Fabulous by any stretch of imagination, great number. On the right now, we're introducing, right, because now we have these schedules, we're introducing the cumulative invested capital over time. And you can see those capitalized intangibles, if you go down most of the way down on the right-hand side, is about $105 billion. So invested capital goes from $311 billion unadjusted to $415 billion adjusted. Now, NOPAT went up a little bit too, but you can see that if you take the new NOPAT number and the new invested capital number, ROIC actually goes down to 30%. Still spectacular, right? But not as high as it was before. Now, if you want a little bit of an intuition, here's what's going on, right? Your base return is this $97 billion over 253, that's that 38%. But to that, you're adding $10 billion of incremental NOPAT, but $100 billion of invested capital, right? So you're taking 38% and you're basically adding a 10% return on that piece. And then the combination of those two things gets you to that 30%, the revised number. So here's a long-term look at ROICs for Microsoft before and after these adjustments. And you can see these things have converged. There were some crazy numbers in the early 2000s for ROIC, but you can get a sense of that. Now, let me just take one step back and say, okay, let's apply this to a larger sample of companies. Here we're looking at the distributions of ROICs for all US public companies from 1963 to 2023, so 60 years of data. The ROICs based on the traditional calculation is the light blue bar, and the adjustments for intangibles would be the dark blue bars, right? So first thing to say is the median and the average ROICs don't change that much from one sample to the other. However, what is important is you see the tails shrink following the adjustment. So fewer very high return on capital businesses and fewer really low return on invested capital businesses. And again, here's the intuition. For the high ROIC businesses, like we saw with Microsoft, we're adding a little bit of NOPAT and a lot of invested capital, so that dilutes the high number. For the low ROIC businesses, we're adding a lot of NOPAT and a little bit of invested capital, and that increases the low number. So that's the net effect when you look at this in the aggregate. So I'll give you one example, Snowflake. The Microsoft would be the better high to lower. Snowflake's an interesting example. It's a software company. Their ROIC goes from negative 319% to positive 15% with this adjustment. So you get a markedly different view of the economics of the business. Now here's just a time series of the ROICs, adjusted and unadjusted. And again, you can see that it makes me feel a little bit better. They sort of follow one another. They're actually pretty close as a series. Now here's another fun illustration. This is ROIC by industry. Those in the back of the room, I really apologize. There's no way you can see any of these details, but you don't need to see any of the details besides some sort of very coarse-grained observations here. So on the left is going to be traditional ROICs. This is ranked by industry, and then you're seeing the 80th and 20th percentile. So the length of those lines, those vertical lines, are going to be a sense of how much variance there is in that particular industry. And on the right is the same series, but now adjusted. So there are two things that I want to draw your attention to, and even the folks in the back, I think, would be able to see these things. Number one is the variance within industries is greater than the variance across industries. And this is important because it underscores that industry is important, but does not dictate a firm's destiny. All industries have companies that create value, and all have companies that destroy value. So when you're thinking about a company from a strategic point of view, it's an acknowledgement that while industry is important, it is not destiny. The second observation, and you can see this on the right, is that adjusting for ROIC intangibles again pulls this high and low numbers closer. So you can see that 80-20 thing is a much tighter thing. So we lower the variance of the distributions of ROICs by industry. Okay, so let me shift gears a bit and talk about the characteristics of these intangibles. By the way, everything I'm going to talk about here are topics that have been very well understood by economists for a long time. So we're not creating, this is not like a new .com thing or like this. These are well understood ideas. I'll just mention there's a lovely book that came out a few years ago called Capitalism Without Capital by Jonathan Haskell and Stan Westlake. So if you're interested in this topic, and by the way, They come up with the 4 S's. It's a little bit pithy, so I'm just going to steal their 4 S's because I thought it was clever marketing. I'm going to give them a nod, but these are the right ideas. So S number 1 is scalability, and not surprisingly, intangible assets often have high upfront costs but low incremental costs. So you can think about writing software code. Writing the code is very costly, but selling it, marginal cost very low. Creating the drug for the instructions for a new drug, very costly. Time soon be creating the pills once it's out there, very cheap. Now I love this. And so one of the big ideas here would be the idea of network effects, right? The value of a good or service increases as more people use that good or service. Today's examples would be things like ride sharing or social networks. But let me just read this quote. I love this just to show you there's nothing new under the sun. There's nothing new under the sun. Here's the quote. A telephone without a connection or at the other end is not even a toy or a scientific instrument. It is one of the most useless things in the world. Its value depends on the connection with another telephone and increases with the number of connections. That, taken from the AT&T annual report 1908. That is almost a perfect contemporary articulation of network effects written about by AT&T well over a century ago. So scalability, let's say, is going to be a positive thing, because if we can capture network effects, that's going to be good. Now, just to be clear, many, many companies talk about this magic thing called network effects. Very few actually enjoy it, but we'll give that as a positive. Sunkenness is the second idea, right, which is tangible assets are going to retain resale value due to their standardization. So you decide to start a coffee stand or store. You're going to buy an espresso machine and maybe a cash register and some tables and chairs for people to come. And if your store does not do well and you go out of business, you can take those things and sell them to somebody else, because that espresso machine and your tables and chairs, your cat will still have some value out there. By contrast, if you do something with software code or write a song that no one likes, there's basically no value in that whatsoever. So be a little bit cheeky. On the left, I put, this is the Sears Tower, which when it was built in 1973 was one of the tallest buildings in the world. It sold in 1994. Blackstone bought this, I'll just give the updated. Blackstone bought this in 2015 for $1.3 billion, right? So even though Sears is long gone, the building retains a lot of value. And on the right is Radio Shack. When Radio Shack, this is not really good math, but their peak valuation was $15 billion as a public company. For you young people, Radio Shack was an electronics distributor that no longer exists. And they did sell the brand. They managed to sell the brand for $15 million, right? So there's really nothing there after that. So that's the second S. And so we'll call that one a negative S, right? Which is to say, if it doesn't work out, there's nothing left, right? Or not much left to hang your hat on. The third S is spillovers. I'd also put this in the negative camp, right? Which is intangible assets are very difficult to protect. They're easy to imitate, even with copyrights and trademarks and so forth. The classic example, by the way, is the iPhone. Nokia at the time the iPhone came out in 2007 had 50% market share, smartphone market, but the iPhone changed the design. And notwithstanding there are certain patents around that, whatever smartphone brand you have in your pocket, even if it's not an iPhone, it's going to have very similar features to what the iPhone introduced back in 2007. Second example on the top there is an example from sports, and this is from the NBA. This is really surprising. At some point, the front office of the NBA figured out that 3 is more than 2. And when they figured that out, they could do an expected value calculation and realize that certain 2-point shots had low expected values relative to their 3-point counterparts. And so people should just take a few steps back and take a 3-point shot with a higher expected value. So that was the death of the mid-range jump shot. So on the left is the season roughly 20 years ago. You can see there are a lot of shots around the hoop, but you can see a lot of mid-range things. And you can see the most recent season we completed, it is now today all shots very close to the rim, which are very high expected value, and then all 3-pointers, right? So it took the NBA a remarkably long time to figure this out, but now if you watch a game, this is basically all that's happening. People going to the rim or people kicking out for 3-point shots, and that's basically all that you see. So the takeaway here, though, is that this is best practices. It's difficult to sustain or protect your intellectual property. It can be done, but it's difficult to do. The last S is synergies. And this is, if you want to be optimistic, this is a positive one. And in innovation, and you study the innovation literature, it's almost always a recombining of existing building blocks. So you have a problem you're trying to solve, you take building blocks that are existent today, and you combine them to solve the problem that we see. So by the way, if you, again, want to be bullish, if more of our building blocks are digital, that allows us to manipulate things faster. I think that this is one of the exciting areas of AI specifically, by the way. And so the list is endless. Now, I learned a lot about this from Brian Arthur from the Santa Fe Institute, which Kim mentioned, and he'd love to talk about jet engines, and I found a cool picture of a jet engine, so I just put that up there. But anyway, this is a recombination of a lot of different technologies to be interesting. So let me finish now with a point on why you should care about this. So the first thing let me just tell you is if we do these data, for example, for the S&P 500, what our numbers show is, and depends again on the assumptions you make, is that S&P earnings with these adjustments are somewhere between 10 and 15% higher than what is stated operating earnings. So automatically it means multiples are 10% lower than what is stated at the headline, right? So when people are comparing history, just be very mindful that it's not apples to apples when you go back beyond a certain point. EBITDA multiples, very similar orders of magnitude, right? So just be mindful of that. Okay, so Here's also what's happened to earnings and the relevance of earnings, the bottom line here. This is work done by Baruch Lev. Many of you probably know his name. He's a professor at New York University and has been working on intangibles now for decades. He developed a proxy for intangible investment, which allowed him to essentially separate the universe of stocks into those above the median, which he called top spenders, and those below the median, which he called bottom spenders. So just imagine you take a population of companies, you split them into two, top and bottom. He then analyzed the correlation between valuation, which is essentially price to book. And there are two observations here that I think are pretty easy to make. Number one is earnings relevance for the top spenders has been coming down very steadily since the 1950s. So you go back to the 1950s, it's actually very relevant for both the top and bottom spenders, and in basically an equal measure. But you can see the top spenders, again, that dark blue, plummeting to a point of almost all irrelevance in the last 20 years. The second is the gap between the top and bottom has widened sharply in the past 70 years. So again, they're a very narrow gap in the 1950s, and now quite a wide gap as well. Now, one of the questions, and I talked to Baruch about this very specifically, one interesting question is why do companies react so violently when earnings are released, still if earnings have lost much of their relevance? And Baruch, I don't know if this has been really well studied, but Baruch argues a lot of it has to do with now earnings guidance versus earnings itself. So often you'll see a typical thing is, the company made the revenues and profits that the market had anticipated or a consensus, but they guided below the future expectations, so the stock sells off. So it's not reflecting what's already happened, it's reflecting what's going to happen going forward. Here's another piece of work done by Baruch and some of his colleagues. What they did here is very interesting. They sorted companies into three bins. The first bin are the profitable firms. So these are old school profitable revenues minus expenses, profits, that's good. The second are what they call real losers. And these are companies where the expenses are greater than the revenues, so they're losing money the old-fashioned way, their business is uneconomic. The third group is what they call the gap losers. And they're losing money because of the accounting rather than because of the underlying economics. Then they match firms by size, by valuation and industry and year. So they're trying to remove other factors to the best of their ability to do that. And then they calculated the total returns. If we invested $1 in each of these areas, what would the performance have been? And what they found was the gap losers were by far the most highest return. Now, there's probably a risk element to that as well, but I think that doesn't compensate fully for this observation. The profitable firms did fine, and then the real losers did the worst. So another interesting observation. This work also relates more directly to the value factor. This is high minus low, basically, so it's book to price, so think about it backwards. So you build a portfolio by going long stocks with high book to price, right, which is basically the inverse of price to book. So those are the cheap stocks. And then you short the low book to price. Those are the expensive stocks, right? And so you build a portfolio and see how that performs. Okay, so it turns out, as you all know very much, the value factor, which I think is distinct from the value investing, by the way, but the value factor has been less effective in recent decades. And part of that, I think, and not an insignificant part of that relates to intangibles. Now, to be super clear, I don't think there's a quantitative firm that doesn't understand this. I think the vast majority of the quant firms now make these adjustments. There's a lot of academic research to show this. Even if you use a simple model, it's going to improve the quality of your signal. Now, this is work done by Baruch Lev and Anup Srivastava, so two of the guys we've already met. It's a little bit hard to interpret this, but basically what they do is they look at the cumulative signal before, which is the red bars, and after, which is the blue bars, after the adjustment by decade. So they're just the signal for the decade, and they start back at the beginning, signal for the decade, start back at the beginning, right? And what you see is, again, not surprisingly, in the 1970s, the signal wasn't improved that much by these intangible adjustments, but as we've gone through time, the signal has gotten much better, the value signal, by making this adjustment, right? So we're getting much more visibility. So with that, I'll stop. I guess I'll wrap it up by going back to quoting Ben Graham, and I'll finish where I started. This is the next paragraph he wrote after the two that I read you, which I think is great, and I think is all value investors and all of those who appreciate Ben Graham very much should take this to heart. This is Graham writing again. We do not think, therefore, that any rules may be reasonably be laid down on the subject of book value in relation to market price. accept the strong recommendation already made that the purchaser know what he is doing, he or she, know what he is doing on this score and be satisfied in his own mind that he is acting sensibly. Right, so what Ben Graham's saying is there is no fast and hard rule about price to book. All there is you should be thoughtful about what you're doing and act sensibly. So I think in the context of modern value investing, I think that reckoning for intangibles is an important step in that acting sensibly. So with that, I'll stop.